Okay, let's just jump right in. When you start saving for retirement, like right at the beginning, you hit this big fork in the road. And maybe it's the most basic question your money's ever going to face. Do you pay taxes on those savings now? Or, do you kind of kick that tax bill down the road and pay it later?
Yeah, and it sounds simple, maybe, but that choice, it's huge. It shapes everything about how your money grows, how you get it back decades later.
It really does. It's not just like financial chatter. It's fundamental.
And that choice, paying now or paying later, that's basically the heart of the difference between the two main retirement accounts most people use, the traditional IRA and the Roth IRA. Understanding how the taxes work for each one, and it's critical if you want to build a smart plan.
Exactly. And that's what this deep dive is really all about today. We're getting into the weeds, the mechanics, the rules, the tax stuff for traditional versus Roth. We've gone right to the source material here, pulling out the key details from official IRS guidance, specifically Publication 590A for 2024 returns, and also looking at explanations from financial resources. So our mission really is to cut through all that complexity, pull out the important bits, and help you understand these things. They're powerful tools, but you need to know how they work to pick the right one.
Right. We're aiming to pull back the curtain on those official rules, explain them, in plain English, and point out the little details that can actually make a massive difference later on. Think of this as your guide through that sometimes tricky tax landscape of saving for retirement.
Okay, so tax is the big divider. We get that. Yeah, but they do have some things in common, right? Start there.
Absolutely. They're both IRAs, individual retirement arrangements. The whole point of both is to help you save specifically for retirement, and they give you tax advantages you just don't get with, say, a regular brokerage account.
They're built on that same idea.
Yeah.
Let's encourage people to save for the future.
Exactly. And maybe the most straightforward common ground, the annual contribution limit, how much you can put in each year. For the 2024 tax year, the maximum you could put into all your IRAs combined, doesn't matter if it's traditional or Roth, it's a combined limit, was $7,000. That's if you were under 50.
Okay, $7,000 under 50. What if you're 50 or older?
Then you get a little bonus. If you hit 50 or were older by the end of 2024, you could add an extra catch-up contribution. That brought your total limit up to $8,000 for the year.
And for 2025, are those numbers changing?
Nope. For 2025, the limits are actually staying put. Still $7,000 if you're under 50 and $8,000 for those 50 and up.
Oh, $7,000, $8,000. Seems simple. But wait, those are just the general limits, right? There's another catch.
Yes, there is. This is really key, and it comes straight from the IRS rules. You can only contribute up to that general limit or your taxable compensation for the year, whichever amount is lower. So if you didn't have any compensation, any earned income, you generally can't contribute to an IRA at all, even if you're under the age limit.
Right. Compensation. What exactly counts as taxable compensation in the eyes of the IRS for this? It's not just any old income, is it?
No, not at all. They're pretty specific. It generally means income you earned from working. So think wages, salaries, commissions, tips, bonuses.
Yeah.
Money you get paid for doing a job. If you're self-employed, it's your net earnings from your business, the profit, but specifically where your personal services are a big part of making that income.
Okay.
Now, the calculation for self-employed folks, it gets a little technical. It's your net profit, but then you have to subtract the deduction for 1/2 of your self-employment taxes and also subtract any contributions you made to retirement plans for yourself, like a SEP IRA or simple IRA.
So for the self-employed, it's the income after those specific deductions, not just the top-line profit.
That's the gist of it. And the sources, they also point out a few less common things that count, like taxable alimony or separate maintenance payments, but only from divorces or separations finalized on or before December 31st, 2018. And only if the agreement hasn't been changed since then to say it doesn't count.
Interesting detail about the date.
Yeah, tax law changes affect that. Another interesting one, for members of the military, non-taxable combat pay actually does count as compensation for IRA contributions.
Really? Even though it's non-taxable?
Yes. It's a specific rule, usually shows up in box 12 of the W-2 form with a code Q. Oh, and for tax years after 2019, certain fellowship and stipend payments for graduate or postdoc studies can count too, even if they're not on a W-2, as long as they're included in your gross income under the rules.
That combat pay rule is a great example of needing to know the specifics in the official guidance. But what kinds of income definitely don't count.
The IRS lists these out clearly too. Things like earnings from property, so interest income, dividend income, capital gains from investments, none of that counts. Pension or annuity income you're already receiving doesn't count. Deferred compensation doesn't count. Basically, if it's passive income or retirement income you're already getting, you can't use that to make new IRA contributions. You need income you earned from working that year.
Okay, so your contribution is capped. It's either that $7,000 or $8,000 limit, or the amount you actually earn from working, whichever is lower. That's the baseline for both traditional and Roth.
Exactly. That earned income, that compensation is the fuel. Without it, you can't put money into an IRA.
All right, let's follow path number one then. The traditional IRA. This is the one people often think of first, the one where the potential big deal is getting a tax break now, like right now this year.
Yes, that's the main draw, potentially. The possibility of deducting your traditional IRA contributions on your tax return, if you can deduct it, that contribution lowers your taxable income for the year you make it, which, can mean a smaller tax bill this April. It's an immediate payback.
Sounds great. Save on taxes today. Who wouldn't want that? But and this is where it gets really interesting, maybe a little messy, that deduction. It's not guaranteed, is it?
Oh, absolutely not. This is probably the biggest point of confusion or complexity with traditional IRAs, whether you can deduct your full contribution or just part of it or maybe none of it. It all depends. It hinges on a few things that are all linked together. Your modified adjusted gross income, or MAGI, your tax filing status single, married filing jointly, etc. And critically, whether you or your spouse, if you file together, were covered by a retirement plan at work, even for just part of the year.
Wow, okay. Even Social Security can factor in sometimes.
Yeah. At higher income levels, receiving Social Security benefits can sometimes affect the calculation for the deduction, adding another layer.
Okay, that phrase, covered by a retirement plan at work for any part of the year. Sounds straightforward, but I bet the IRS definition isn't quite so simple. What does covered actually mean here?
You bet right. This trips people up all the time. The IRS has different definitions depending on the type of plan. Let's take defined contribution plans first. These are things like your 401k, 403b, profit sharing plans. For those, you're generally considered covered if any money either from your employer or from your own salary deferrals was put into or allocated to your account for the plan year that ends within your tax year.
So it's tied to the plan year, which might not match the calendar year.
Exactly. And even if the actual contribution gets made, say, in February of the next year, but it's for the plan year that ended in the previous calendar year, you could still be considered covered for that previous year. For plans where the employer contribution is discretionary, like a profit-sharing plan, it can be even more nuanced. You might not be technically covered until the year the employer actually makes that contribution, even if it relates to work you did in an earlier year.
Okay, so it's really about whether funds related to that specific tax year ended up in your account, regardless of timing.
Pretty much. And crucially, the sources emphasize this. You're covered even if you aren't vested yet. Even if you left the job and forfeited the money later, if contributions were made for you for that plan year, you were covered.
Okay, what about the other main type, defined benefit plans, like old school pensions?
Right, pensions. For those, it's not about contributions, it's about eligibility. If you are eligible to participate in the plan for the plan year ending within your tax year, you're considered covered. This is true even if you decided not to participate, or maybe you didn't make employee contributions if they were required, or maybe you didn't even work enough hours that year to actually earn or accrue a benefit for that specific year. Just being eligible is enough.
Wow. So for a pension, just the ability to be in the plan makes you covered for this IRA deduction rule, even if you opted out or didn't qualify for a benefit that year.
That's what the IRS guidance says. Eligibility is the trigger for defined benefit plans. Whether you're vested or actually earned anything that year doesn't matter for this specific rule about IRA deductions.
How would you even know for sure?
Well, your form, W-2, the tax form from your employer, is supposed to have a box checked, usually box 13, retirement plan, if you were considered covered for the year. That's usually a good first indicator. But ultimately, the actual IRS rules we just discussed are what defines it.
Are there things that feel like retirement plans but don't count as coverage for this specific purpose?
Yes, definitely. Being covered by Social Security or railroad retirement, that doesn't count as being covered by an employer plan for IRA deduction rules. Also, if you're getting pension payments from a job you left years ago, that doesn't make you covered by a plan at your current job. And there are some really specific exceptions, too, like for certain military reservists, depending on how many days they were on active duty, or for volunteer firefighters based on how small their accrued benefit is. But the main idea is about coverage under a plan with your current employer.
Okay, so understanding this covered status is super important because it acts like a gate, right? It determines whether your income level starts to limit your ability to deduct the traditional IRA contribution.
It's the absolute key. If neither you nor your spouse, if filing jointly, were covered by a workplace plan for the entire year, the rules are much simpler. In that case, your traditional IRA contribution is fully deductible. Doesn't matter how high your income is, you just contribute up to the limit, 7-carat $8 or your compensation, and you can deduct the whole thing.
Okay, that's the easy scenario. But
Yeah.
realistically, many people are covered by a plan at work.
Oh.
Or maybe their spouse is, and they file taxes together. What happens then?
Then the income limits kick in, specifically your modified adjusted gross income, or MEGI. Your MEGI determines how much, if any, of your traditional IRA contribution you can actually deduct. There are specific MGI ranges, called phase-out ranges. If your income falls within that range, the amount you can deduct starts to shrink. And if your MGI is above the top end of that range, your deduction is completely gone, zero deduction.
Can you give us a rough idea of those income ranges? I know they change.
They do, they're indexed for inflation. But let's look at 2024, for example. If you were single and covered by a plan at work, your deduction started phasing out at a MGI of $77,000 and was completely gone at $87,000.
Okay, not super high for a full phase out.
Right. Now, if you were married filing jointly and both of you were covered by a plan at work, the phase-out range was higher, $129,000 up to $149,000 MGI for 2024.
And what if only one spouse was covered?
That's a bit more complex. If you're married filing jointly and say you have a 401k, but your spouse doesn't have a plan at their job, your deduction, the covered spouse, phases out in that same 129K, 149K range. But your spouse's IRA deduction phases out at a much, much higher range.
Right.
$230,000 up to $240,000 RNJI for 2024.
Wow, that's a big difference for the non-covered spouse.
It is, and these numbers nudge up a bit for 2025. That single covered range goes to $83,000, $93,000. The both covered range goes to $137,000 to $157,000. So you have to check the numbers for the specific year.
Okay, so lots of numbers there, but the big picture is if you earn a decent income and you or your spouse have a retirement plan at work, you might find that your traditional IRA contributions aren't deductible or only partially deductible.
Exactly. That's why you absolutely have to figure out your MGI and know your coverage status before you just assume you can deduct that IRA contribution.
And if you do contribute, but you can't deduct it because your income is too high, what happens then? You still made the contribution.
Right. This leads us to non-deductible contributions. And this is where keeping good records becomes absolutely vital. If you make a contribution to a traditional IRA, but you can't deduct some or all of it, you need to track that. You're essentially putting after-tax money into your traditional IRA. This creates what's called basis.
Basis, like the amount you already paid tax on.
Precisely. And the way you track this is using IRS Form 8606. You file this form for any year you make a non-deductible contribution to a traditional IRA. It helps you keep a running total of all your non-deductible contributions across all your traditional IRAs.
Why is tracking that basis so important? Seems like extra paperwork.
It's crucial because of what happens down the road when you take money out of the traditional IRA. When you take distributions in retirement, the portion of the withdrawal that represents your basis, those non-deductible contributions, comes back to you completely tax-free. The rest of it, any contributions you did deduct, plus all the investment earnings over the years, that part gets taxed as ordinary income when you withdraw it.
Okay, so the withdrawal isn't all taxable if you had basis. How do they figure out the split?
It's done pro rata. Basically, you look at the total basis across all your traditional IRAs and compare it to the total value of all your traditional IRAs. That ratio determines what percentage of any withdrawal is considered a tax-free return of basis and what percentage is taxable. Form 8606 helps you do this calculation.
And if you don't track your basis with Form 8606?
Big mistake. The IRS will likely assume all your contributions were deductible, or should have been, and they'll tax the entire withdrawal. You could end up paying taxes again on money you already paid tax on when you earned it. Double taxation.
Ouch. Okay, Form 8606 is your friend if you make non-deductible traditional IRA contributions. Got it.
A very important friend.
Let's talk about the growth inside the traditional IRA. Once the money's in there, whether it's deductible or not, what's the tax situation while it's just sitting there growing?
This is the other main tax perk of the traditional IRA, tax-deferred growth. While the money stays inside the IRA, any earnings, dividends, interest, capital gains when you sell investments within the account. None of that is taxed year after year. It just gets reinvested and grows without that annual tax drag. This allows your money to compound potentially much faster than it would in a regular taxable account where you're paying taxes on gains and income each year.
Tax-deferred growth is powerful. But, like we said at the start, taxes aren't avoided forever. The tax bill comes due eventually. How does that work when you take money out?
Right. When you start taking distributions, typically in retirement, from a traditional IRA, that money is generally taxed as ordinary income in the year you receive it. The idea is you likely got a tax break up front when you contributed, if deductible, and you got tax-deferred growth, so now you pay the income tax when you actually use the money. Hopefully, as the theory goes, you might be in a lower tax bracket in retirement than you were during your peak earning years.
And if you had those non-deductible contributions, the basis.
That's where tracking it pays off. Like we said, using Form 8606, you calculate the portion of each withdrawal that's a tax-free return of your basis. So each withdrawal becomes a mix, part taxable earnings and deductible contributions, part tax-free return of basis.
Okay. What about taking money out early, before retirement age? Are there penalties?
Yes, usually. There's typically a 10% additional tax, often called an early withdrawal penalty, on distributions taken from a traditional IRA before you reach age 59 and a half. This 10% is on top of the regular income tax you'll owe on the taxable portion of the withdrawal. It's basically Uncle Sam saying, hey, this money is meant for retirement. Don't touch it early unless you have a really good reason.
10% extra tax definitely stings.
Ugh.
Are there ways around that penalty? The sources mention IRS publication 590B has the details.
Yes, the IRS does allow exceptions to this 10% penalty in certain specific situations, even if you're under 59 and a half. Some of the common ones include taking money out because you become totally and permanently disabled, or using it for qualified higher education expenses for yourself, spouse, kids, or grandkids. Also, withdrawals for certain unreimbursed medical expenses that exceed a certain percentage of your adjusted gross income, AGI. Using up to $10,000 total lifetime for a qualified first-time home purchase is another big one.
So major life events or needs.
Exactly. Also, if the IRA owner dies, distributions taken by their beneficiary are not subject to the 10% penalty, regardless of the beneficiary's age. And some newer exceptions from the Secure 2.0 Act include things like withdrawals by victims of domestic abuse or for certain emergency personal expenses, though those have specific limits and rules.
Oh, and if you properly withdraw an excess contribution by the tax deadline, that withdrawal is also exempt from the 10% penalty.
Okay, so there are quite a few potential escape hatches for that penalty. But, and this seems important, even if you avoid the 10% penalty, the withdrawal itself is still generally taxable income, right?
That is a crucial distinction, yes. Getting an exception usually just saves you the extra 10% tax. It doesn't typically make the withdrawal tax-free if it came from earnings or deductible contributions. You still owe regular income tax on that portion.
Got it. Penalty waived doesn't mean tax waived. Are there any other, less obvious ways you could accidentally trigger taxes or penalties with a traditional IRA?
Hidden traps.
Yeah, there are a couple of things the IRS flags. You generally can't use your IRA as collateral for a loan. If you pledge any part of your traditional IRA as security for a loan, the IRS treats that pledged amount as if you took a distribution. Similarly, if you have an annuity contract inside your IRA and you borrow against that annuity contract, the amount you borrow is treated as a taxable distribution from the IRA.
So basically, don't try to borrow against your IRA or use it as loan security.
Exactly. Those actions are considered prohibited transactions or deemed distributions, and they can trigger regular income tax and potentially that 10% early withdrawal penalty if you're under 59 and a half. It's like taking the money out, even if you didn't physically receive cash.
Good to know. Keep the IRA separate. Okay, let's shift gears to the other end of the timeline. Required minimum distributions, or RMDs.
Ah, yes, RMDs. This is a really significant difference compared to the Roth IRA we'll discuss later. With the traditional IRA, the government doesn't let you keep that tax-deferred growth going forever. Eventually, they require you to start taking money out.
You have to start withdrawing, whether you need the money or not. And the starting age for this keeps changing, right? Thanks to laws like the Secure Act and Secure 2.0, what's the current rule?
It depends on when you were born. If you were born between 1951 and 1959, you generally have to start taking RMDs by April 1st of the year after you turn age 73. If you were born in 1960 or later, the starting age is pushed back further. You have to start RMDs by April 1st of the year after you turn age 75.
73 or 75, depending on birth year.
Right. And if you were born before 1951, you likely started RMDs already under the older age 72 rule. The first RMD is due April 1st of the year after you reach your required beginning age, but all subsequent RMDs must be taken by December 31st of each year.
Okay. How do you figure out how much you have to take out each year? What's the calculation?
The RMD amount is generally calculated based on two things: the fair market value of your traditional IRA account balance as of December 31st of the previous year, and a life expectancy factor from IRS tables. You take that prior year-end balance and divide it by the distribution period factor found in the appropriate IRS life expectancy table in Publication 590B. Most people use the Uniform Lifetime Table. There's a different table if your spouse is your sole beneficiary and is more than 10 years younger than you.
Dividing the balance by a factor.
Yeah.
Okay. What if someone has, like, 3 different traditional IRA accounts? Do they have to calculate and take an RMD from each separate account?
This is a point where the rules offer some helpful flexibility for IRA owners. You do have to calculate the RMD amount separately for each traditional IRA you own. However, you don't necessarily have to take the withdrawal from each account. You can add up the calculated RMD amounts for all your traditional IRAs, and then you can take that total required amount from just one of the IRAs or from any combination of them, as long as the total withdrawn by December 31st equals or exceeds the total RMD required across all accounts.
Ah, that's useful. So calculate for each, but aggregate the withdrawal. How does that compare to RMDs from, say, 401k plans?
That's a key difference. For employer plans like 401ks or 403bs, you generally must calculate and take the RMD separately from each plan account. You can't usually aggregate those, but with IRAs, you have that aggregation option.
Good distinction. Now, what if you mess up, you forget or you miscalculate, and you don't take out the full RMD amount by the deadline?
The penalty for missing an RMD is significant. It's an excise tax. Currently, it's 25% of the amount that you should have withdrawn but didn't.
25%? Wow, that's steep.
It is. Now, Secure 2.0 did introduce a way to potentially reduce that penalty. If you realize the mistake and correct the shortfall quickly, generally within a 2-year correction window, and file the right forms, the penalty can be reduced from 25% down to 10%. But still, even 10% is painful. You have to report this penalty tax on Form 5329. It's a very strong incentive to get your RMDs right and take them on time.
No kidding. 25% is a huge hit. Okay, let's talk about moving money between accounts. Rollovers. This is how you shift funds around without causing immediate taxes, right?
Exactly. Rollovers are super important for managing your retirement savings, especially if you change jobs, want to consolidate accounts, or maybe move to a different custodian.
How does it work just moving money from one traditional IRA to another traditional IRA?
The most common way is an indirect rollover. You take a distribution from traditional IRA Call 1, and then you have 60 days to deposit that money into traditional IRA Tack 2. If you complete it within the 60 days, it's tax-free.
60 days. That sounds like a deadline you don't want to miss.
Definitely not.
And isn't there some kind of limit, like a 1 rollover per year rule? How does it work?
Yes, and this rule often causes confusion. It applies specifically to these indirect 60-day rollovers between IRAs. You are limited to making only one such indirect rollover from any of your IRAs, traditional or Roth, to any of your IRAs within any 12-month period. It's not per account, it's one per person per 12 months for this type of rollover where you physically receive the funds.
Okay, 1 indirect rollover per 12 months. What types of transfers are not subject to this limit?
Crucially, the limit does not apply to direct trustee-to-trustee transfers. That's where the money moves directly from IRA custodian #1 to IRA custodian #2 without you ever touching it. You can do as many of those as you want. The limit also does not apply to conversions from a traditional IRA to a Roth IRA.
So direct transfers equals unlimited. Conversions unlimited. Taking the cash yourself and moving it once per 12 months across all IRAs.
That's the key takeaway from the guidance on that rule.
What about moving money from an old employer plan, like a 401k from a previous job, to a traditional IRA?
Very common and generally straightforward. You can roll over eligible distributions from qualified employer plans, 401k, 403bs, governmental 457bs, into a traditional IRA. Importantly, that 1 rollover per year rule we just talked about does not apply to rollovers coming from an employer plan into an IRA. You could roll over funds from several different old 401ks into your IRA in the same year if you wanted to.
And sometimes people use the traditional IRA as a temporary holding spot for that employer money, a conduit IRA.
Yes, that's a concept. If you roll money from Employer Plan A into a traditional IRA, and you think you might later want to roll that same money into a new Employer Plan B, if Plan B accepts rollovers, you might keep it separate in that conduit IRA.
Why keep it separate?
Because some employer plans will only accept rollover money that originated from another employer plan. If you mix that conduit IRA money with your regular annual traditional IRA contributions, you might lose the ability to roll the original employer portion into a new workplace plan later. The source warns about commingling funds if you think you might want to roll it into a future employer plan.
Good tip. Can you go the other direction? Roll money from a traditional IRA back into an employer plan.
Sometimes. An employer's qualified plan, like a 401k or 403b, may choose to accept rollovers from a traditional IRA, but they are not required to allow it. You have to check the specific plan's rules. If they do accept it, typically only the pre-tax money in your traditional IRA can be rolled into the employer plan tax-free. Any non-deductible basis you have in your traditional IRA generally cannot be rolled into an employer plan. It has to stay in an IRA or be distributed.
Okay, back to that 60-day deadline for indirect rollovers.
Yep.
Life happens. What if there's a hurricane or the financial institution makes a mistake and you miss the 60-day window? Are you just stuck with a taxable distribution?
Not necessarily. The IRS does have procedures to potentially waive the 60-day deadline under certain circumstances. There are some situations that qualify for an automatic waiver, like if the financial institution messed up and didn't deposit the funds correctly, even though we gave them instructions on time. But more commonly now, there's a process for self-certification. You can essentially certify to the receiving IRA custodian that you missed the 60-day deadline due to one of several specific reasons listed by the IRS.
Self-certify. You just tell them why you were late. What reasons count?
The IRS provides a list. Things like an error by the financial institution, your check was misplaced and never cashed, you experienced a death, serious illness or hospitalization affecting you or a family member, a natural disaster, incarceration, restrictions imposed by a foreign country, postal error, basically events beyond your reasonable control.
So if one of those applies, you write a letter to the IRA provider explaining it, stating it wasn't your fault, and you deposited the money as soon as you could.
Pretty much. You provide a written certification. There's usually a model letter you can adapt. Give it to the IRA custodian when you make the late rollover deposit, and keep a copy for your tax records. This process is meant to make it easier than going through the formal IRS ruling process for common hardship situations.
Is that self-certification binding on the IRS?
That's an important point. No, the self-certification itself is not an official IRS waiver. It allows the custodian to accept the late rollover. But if you get audited later, the IRS can still review your situation and decide whether you actually met the requirements for a waiver. If they decide you didn't, they could retroactively treat it as a taxable distribution with potential penalties.
So it's helpful, but not a guarantee against an IRS challenge.
Right. If you don't qualify for an automatic waiver or aren't comfortable self-certifying, the other option is to formally request a private letter ruling directly from the IRS asking for a waiver. But the source points out that usually involves paying a significant user fee, often thousands of dollars.
Yikes. Self-certification sounds much better if you qualify. Okay, last thing on traditional IRAs. What if you accidentally put in too much money? Excess contributions.
Right, contributing more than your allowed limit for the year, either the $7K limit or your compensation limit, whichever is lower. If you do that, the excess amount is hit with a 6% excise tax.
6%, is that just a one-time thing?
No, and that's the painful part. It's a 6% tax for each year that the excess contribution remains in your IRA at the end of the year. It keeps getting taxed year after year until you fix it.
Ouch, that could add up. How do you fix it and stop the tax?
The best way is to withdraw the excess contribution, plus any investment earnings that excess amount generated while it was in the account, before the due date of your tax return for the year you made the excess contribution, including any extensions you get. If you do that by the deadline, you don't pay the 6% excise tax. The excess contribution itself comes out tax-free, since it was never deductible. However, the earnings you withdraw on that excess amount are generally taxable as income in the year you made the contribution. And those earnings might also be subject to the 10% early withdrawal penalty if you're under 59.5, unless one of the exceptions applies.
Okay, so get the excess principal and its earnings out before the tax deadline, plus extensions. That avoids the 6% penalty, but you still might owe tax and maybe a 10% penalty on the earnings portion.
That's the standard fix. The source also mentions that if you've already filed your return, you generally have an extra 6 months after the original due date, without extensions, to withdraw just the excess contribution without the earnings. If you do that, you'd likely need to file an amended return, Form 1040X. There's also an option to apply an excess contribution from 1 year towards the next year's contribution limit, but doing that does not avoid the 6% tax for the year the excess first occurred or any other year it remained in the account before being applied. Withdrawing it is usually cleaner.
That 6% penalty stacking up year after year sounds like a really good reason to fix excess contributions quickly. And you mentioned Form 5329 for penalties.
Yes, Form 5329, additional taxes on qualified plans, including IRAs and other tax-favored accounts, is where you'd report and pay the 6% tax on excess contributions if you didn't correct them in time. It's also used for the 10% early withdrawal penalty and the penalty for RMD shortfalls.
All right. That was a very deep dive into the traditional IRA. Lots of rules, lots of details. Now let's flip the coin and look at the Roth IRA. This is the one often described as the tax-free later option.
Exactly. The Roth IRA is basically the mirror image when it comes to the main tax benefit. With a Roth, you get no upfront tax deduction when you put money in. You contribute money that you've already paid income tax on. It's after-tax money going in.
So no tax break today. Why would someone choose that then? What's the payoff?
The payoff comes later, and it can be huge. When you eventually take qualified withdrawals from your Roth IRA in retirement, the money comes out completely, 100% tax-free. And that includes not just the contributions you originally put in, but all the earnings, all the growth that accumulated over potentially decades. All of it can be withdrawn without owing any federal income tax.
Tax-free growth and tax-free withdrawals in retirement. That sounds incredibly appealing. But there's a catch on the front end, right?
Yeah.
Unlike the traditional IRA, not everyone can contribute directly to a Roth, even if they have compensation.
Correct. This is a major hurdle for many people, especially higher earners. Your ability to make a direct contribution to a Roth IRA is limited by your income specifically, that modified adjusted gross income, MAGI figure again, and your tax filing status. If your MGI is too high, your ability to contribute gets reduced or phased out, and if it's above a certain threshold, you're completely barred from making direct Roth contributions for that year.
Okay, what were those income limits for, say, 2024? And what are they looking like for 2025?
For the 2024 tax year, if you were single, head of household, or married filing separately and didn't live with your spouse, the ability to contribute started phasing out at $146,000 of MAGI and was completely gone at $161,000 or more.
$161K MAGI for single filers in 2024, no Roth contribution allowed directly.
Right. For people who were married filing jointly or qualifying surviving spouses, the phase-out range was much higher in 2024. Started at $230,000 MGI and ended at $240,000. So if your joint MGI was $240,000 or more, no direct Roth contribution.
And for 2025, those numbers are going up.
Yes, adjusted for inflation. For 2025, for singles and most other non-joint filers, the phase-out range is projected to be $150,000 to $165,000 MAGI. For married filing jointly, the 2025 phase-out range is expected to be $236,000 to $246,000 MAGI.
So even if you have the earned income, if your MGI creeps above those top numbers, $165K for singles, $246K for joint filers in 2025, you're simply locked out of making direct Roth contributions. That's a really big difference from the traditional IRA.
It is. With the traditional, high income only potentially eliminates the deduction. It doesn't stop you from making the contribution itself as a non-deductible contribution. With the Roth, high income can completely block direct contributions.
Which is why people talk about the backdoor Roth IRA maneuver.
Exactly. That's a strategy some high earners use. It typically involves making a non-deductible contribution to a traditional IRA, which has no income limit, and then promptly converting that traditional IRA to a Roth IRA. But the direct contribution path has strict income limits.
Okay, so just to recap the contribution limits for Roth.
Yeah.
You still have the overall $7,000 or $8,000 annual limit based on age and compensation, right?
Correct. That overall limit applies to your combined contributions to all IRAs, traditional and Roth.
But then the MGI limits act as a second filter specifically for the Roth portion, potentially reducing how much of that $7K or $8K you can actually put into the Roth, maybe even down to zero.
Perfect summary. You have the overall cap, and then the MGI phase-out specifically limits the Roth piece. And remember, any amount you contribute to a traditional IRA first reduces the amount you can contribute to a Roth in the same year. The total can't exceed that $7K or $8K limit.
Okay, inside the Roth account, just like the traditional, the investments grow tax-free year after year.
Yes, that tax-free growth is the other side of the Roth coin. Dividends, interest, capital gains, they all compound within the account without creating an annual tax bill.
All right, now for the really exciting part for a lot of people, getting money out of the Roth. This seems to be where its flexibility really stands out.
It really does. This is probably one of the most talked about, most celebrated features of the Roth IRA. Let's break it down. First, your contributions. The actual dollars you put into the Roth over the years. You can withdraw those contributions, your basis, at any time for any reason, and it's always completely tax-free and penalty-free.
Anytime, any reason, no tax, no penalty on the contributions.
Correct. Since you already paid income tax on that money before it went into the Roth, the IRS lets you take your principal back out whenever you want or need to, no strings attached regarding taxes or penalties. It's like pulling money from a savings account in that respect.
That ability to tap your contributions is a huge safety net or a flexibility feature. It makes the Roth feel less locked up than a traditional IRA.
Absolutely. It gives people peace of mind knowing they can get their own money back if a major emergency hits without penalty.
Okay, that's the contributions. What about the earnings? The growth on top of your contributions. Taking those out has rules, right?
Yes. Accessing the earnings tax-free and penalty-free requires meeting certain conditions. These are called qualified distributions or qualified withdrawals. To get the earnings out qualified, you need to meet two main requirements.
2 requirements for qualified earnings withdrawals. What's the first one?
The first is the 5-year holding period rule. You need to have had a Roth IRA open and funded for at least 5 full tax years before you can take qualified withdrawals of earnings. And this clock starts ticking on January 1st of the very first year you made a contribution to any Roth IRA. It doesn't matter which specific Roth account you withdraw from later or when you contributed to that account. It's all based on when your first ever Roth IRA contribution was made.
Okay, 5 tax years starting January 1st of the year of your first contribution. So if I open and funded my very first Roth IRA in, say, December 2024.
Then your 5-year clock started on January 1st, 2024. So you wouldn't satisfy the 5-year rule until January 1st, 2029.
Got it. 5-year clock, that's condition number 1. What's the second condition needed for earnings to be qualified?
In addition to satisfying that 5-year rule, you also have to meet at least one of these specific conditions at the time you take the withdrawal of earnings. You must be age 59 and a half or older. Or you must be totally and permanently disabled. Or the withdrawal is made by your beneficiary or estate after your death. Or the withdrawal is used for a qualified first-time home purchase, but there's a $10,000 lifetime limit per person for this specific purpose.
Okay, so meet the 5-year rule, AND be 59 and a half plus II or disabled or dead, beneficiary takes it, or use up to $10 for a first home. If you meet both the 5-year rule and one of those conditions, then the earnings come out tax-free and penalty-free.
Exactly. It's a qualified distribution of earnings.
What happens if you take out earnings but you haven't met both requirements? So you met the 5-year rule but you're only 50, or you're 60 but you only opened the Roth 3 years ago.
Good question. If you take out earnings and you fail to meet both the 5-year rule and one of those qualifying conditions, age 59 and a half, disability, etc., then it's considered a non-qualified withdrawal of earnings. In that case, the earnings portion of your withdrawal will be subject to ordinary income tax. And if you're also under age 59 and a half, those earnings will typically also be hit with the 10% early withdrawal penalty unless a specific penalty exception applies.
Oh, okay. So non-qualified earnings get taxed and potentially penalized with the 10% tax if under 59 and a half. You mentioned something about withdrawal ordering earlier for traditional. Does that apply to Roth too? How does the IRS know if I'm taking out contributions or earnings?
Yes. The IRS has very specific ordering rules for Roth withdrawals, and they're actually quite favorable to the account owner. Money is considered to come out of a Roth IRA in this order. First, you withdraw your regular contributions. These are always tax-free and penalty-free, as we discussed. Second, you withdraw any money that came from conversions or rollovers from other retirement accounts. These have their own nuances, for instance. Each conversion amount generally has its own 5-year clock, just to avoid the 10% penalty on withdrawing the converted principal early, though the converted principal itself isn't taxed again. And only after you've withdrawn all your contributions and all your conversion rollover amounts do you start tapping into the earnings.
That ordering seems really important. It means you can always pull out your contributions first, tax-free and penalty-free, before you even have to worry about the rules for taxing or penalizing the earnings.
Exactly. It provides significant flexibility, especially in the early years, or if you need access before age 59 and a half. You can get your principal back first.
Now, you listed exceptions to the 10% penalty for early withdrawals from traditional IRAs, disability, education, first home, etc. Do similar exceptions apply to potentially penalized earnings withdrawals from a Roth if you're under 59 and a half?
Yes, many of the same exceptions that waive the 10% penalty for traditional IRA withdrawals also apply to non-qualified withdrawals of earnings from a Roth IRA if you're under 59 and a half. So things like disability, qualified higher education expenses, the $10 K first-time home purchase, certain high medical expenses, paying for health insurance premiums while unemployed, these situations can waive the 10% penalty on the earnings withdrawal, even if you haven't met the 5-year rule or reached age 59 and a half.
Okay, so let's say I'm 45, I opened my Roth 10 years ago, so the 5-year rule is met, and I take out some earnings to pay for qualified college costs. What happens?
In that case, the higher education expense is an exception to the 10% penalty, so you avoid the 10% penalty. But because you are not yet age 59 and a half or disabled, etc., the earnings withdrawal is still considered non-qualified. Therefore, those earnings would be subject to ordinary income tax, even though the penalty is waived.
Huh. So the exception saved me the 10% penalty, but because I wasn't 59 and a half, the earnings were still taxable income, even though I met the 5-year rule.
Precisely. That's a critical point the sources make clear. The penalty exception often just waives the penalty, not the underlying income tax on the earnings, unless you've also met both the 5-year rule and one of the primary qualifying conditions like age 59 and a half or disability.
Okay, let me try to summarize the Roth withdrawal rules, make sure I've got this. Contributions. Always come out first, always tax-free, always penalty-free, anytime, any reason. Easy. Earnings come out last. To get them tax-free and penalty-free, you need both the 5-year rule met and be 59 and a half plus, or disabled, dead, first home, $10. If you take earnings out early, under 59 and a half, without meeting one of those conditions, they're taxable and hit with a 10% penalty, unless a specific penalty exception, like education, medical, applies. If an exception applies, you avoid the 10% penalty, but the earnings are still taxable income if you haven't met the 5-year rule A and D, the 59 and a half plus disability, etc. condition.
You nailed it. That covers the different scenarios for accessing Roth funds. The baseline is your contributions are always safe and accessible. The earnings require meeting the test for the full tax-free benefit.
That flexibility, especially on contributions, is definitely a huge selling point for the Roth.
It really is for many people.
And now maybe the other most celebrated feature of the Roth IRA, especially compared to the traditional, RMDs, required minimum distributions.
Yes, this is simple and powerful. For the Roth IRA, there are NO required minimum distributions during the lifetime of the original account owner.
None, ever.
None. Ever. As the person who opened and funded the Roth IRA, you are never forced by the IRS to take money out no matter how old you get. You can let it grow tax-free for your entire life if you choose.
That is a massive difference from the traditional IRA, where you have to start taking money out at age 73 or 75.
Huge difference. It gives you incredible control over your retirement income stream and your tax situation later in life. You decide when or if you want to tap into those funds. It's also a significant benefit for estate planning, as the account can potentially continue growing tax-free until passed to beneficiaries.
So beneficiaries do have RMD rules eventually.
Yes. Once the original Roth IRA owner passes away, the beneficiaries who inherit the Roth IRA are typically subject to rules requiring them to withdraw the assets over a certain period, often 10 years for non-spouse beneficiaries under current law. But the original owner never has RMDs.
Okay. Let's talk about getting money into a Roth IRA from other places,
Yeah.
like converting a traditional IRA to a Roth. That's a big one.
Yes, conversions are a very common way funds get into a Roth IRA, especially for people whose income is too high to contribute directly. That backdoor Roth strategy often involves a conversion step. You can convert funds from a traditional IRA, a SEP IRA, or a simple IRA after its initial 2-year holding period into a Roth IRA.
But it's not free, right? What's the tax cost of converting?
Correct. There's usually a tax cost. When you convert pre-tax money from a traditional IRA or SEP simple to a Roth IRA, the amount you convert is generally treated as taxable income in the year the conversion happens.
So you're essentially choosing to pay the income tax on that deferred money now in order to get tax-free growth and tax-free withdrawals later from the Roth.
That's exactly the trade-off. You accelerate the tax payment. If your traditional IRA contained any non-deductible contributions basis, that portion of the conversion would be tax-free. But any deductible contributions and all the accumulated earnings being converted are added to your ordinary income for the year of conversion. Form 8606 is used again here to figure out the taxable amount if you have basis.
Can you convert any time? Does that one rollover per year rule apply?
No, the one rollover per year rule does not apply to conversions. You can do multiple conversions in a year if you want. However, a really important point from recent tax law changes. Conversions made from a traditional IRA or SEP symbol to a Roth IRA after December 31st, 2017 cannot be undone. You can't recharacterize or reverse a conversion anymore. Once you convert, you're committed, and the tax on the conversion is due.
Oh, wow. No takebacks on conversions post-2017. That makes the decision to convert even more critical.
Absolutely. You need to be sure you want to do it and can handle the tax bill.
Okay, what about moving money from an employer plan, like a 401k, directly into a Roth IRA? Can you do that?
Yes, you can also roll over eligible distributions from qualified employer plans directly into a Roth IRA. This is sometimes called a rollover conversion. Similar to converting a traditional IRA, the pre-tax portion of the money coming from your 401k or other employer plan becomes taxable income in the year you roll it into the Roth IRA. Any after-tax contributions you might have made to the employer plan could potentially be rolled over tax-free.
And is it better to do a direct rollover here?
Generally, yes. If the distribution from the employer plan is paid directly to you first, an indirect rollover, the plan administrator is usually required by law to withhold 20% for federal income taxes. So you'd only receive 80% of the pre-tax amount. To get the full amount into the Roth IRA within 60 days, you'd have to make up that missing 20% from your own pocket and then wait to get the withheld amount back when you file your taxes, assuming it covers the tax due. If you do a direct rollover where the money goes straight from the employer plan custodian to the Roth IRA custodian, there's no mandatory 20% withholding on the pre-tax amount. You just owe the income tax on the converted amount when you file your return.
Direct rollover avoids the withholding headache. Good tip. The sources also mentioned something about non-spousal beneficiaries.
Yes, non-spouse beneficiaries who inherit assets from a deceased employee's qualified plan, like a 401k, generally have the option to roll those assets directly into an inherited Roth IRA. The rollover would still be taxable in the year it occurs, but it allows the funds to potentially grow tax-free within the inherited Roth IRA before being distributed under the beneficiary rules.
Okay, so the theme here is moving pre-tax money from a traditional IRA or an employer plan into a Roth IRA generally triggers income tax on that pre-tax amount in the year you do it.
That's the fundamental price of admission for getting money into the tax-free Roth environment from a pre-tax source.
You mentioned recharacterizations earlier and how you can't recharacterize a conversion anymore, but can you recharacterize a contribution?
Yes, you still can recharacterize contributions. This means if you make a contribution to one type of IRA, say a Roth, for a particular year, you can later change your mind and treat it as if you had originally contributed it to the other type of IRA, say a traditional, or vice versa. You have to do this recharacterization by the tax filing deadline for that year, including any extensions, and when you recharacterize, you also have to move the original contribution plus any net income or account for any loss that contribution earned while it was in the first account.
Why would someone do that?
A common reason is contributing to a Roth IRA early in the year, then finding out later when you do your taxes that your income ended up being too high to qualify for a Roth contribution. You could then recharacterize that Roth contribution, plus earnings losses, into a traditional IRA contribution for that same year, potentially non-deductible if your income is also too high for the deduction. It's a way to fix a contribution that wasn't allowed, or maybe just to optimize based on your final tax situation.
So recharacterizing is for fixing or changing the type of your annual contribution before the deadline. Conversions are different and now irreversible.
Exactly. You report recharacterizations on Form 8606 as well.
Okay, last movement question. What about moving money out of a Roth IRA to somewhere other than your bank account? Can you roll a Roth IRA into another Roth IRA? Or into an employer plan?
You can definitely roll funds from one Roth IRA to another Roth IRA tax-free. The same 60-day rule applies for indirect rollovers, and the same one rollover per 12 months limit applies to those indirect Roth-to-Roth rollovers. Direct trustee-to-trustee transfers between Roth IRAs are unlimited and often safer. However, you absolutely cannot roll over funds from a Roth IRA into a qualified employer plan like a 401k or 403b. Money in a Roth IRA either stays in a Roth IRA or comes out as a distribution to you or your beneficiary. It doesn't flow back into the employer plan system.
So money can flow from employer plans and traditional IRAs into Roth IRAs, usually creating tax. But money cannot flow from a Roth IRA back into an employer plan. It's kind of a one-way street into the Roth world from the employer world.
That's a good way to think about it. Now, money in a designated Roth account within an employer plan, like a Roth 401k, can be rolled over to another designated Roth account or into a Roth IRA. But a standalone Roth IRA itself can't go back into an employer plan.
Wow. Okay. We have covered a ton of ground here. All the details on contributions, taxes, growth, withdrawals, RMDs, rollovers, penalties for both traditional and Roth.
Let's try to zoom out and bring it back to that core decision for the listener. Which path should you choose?
Yeah, after all that detail, it boils down to that fundamental difference in tax timing we started with. Do you want the potential tax break now with the traditional IRA, knowing you'll pay taxes on withdrawals later? Or do you forego the break now with the Roth, pay taxes up front, but get tax-free withdrawals later?
So based on everything we've unpacked from the rules and the guidance, who tends to lean which way? Generally speaking, the traditional IRA might look more attractive if you think you're in a significantly higher tax bracket today than you expect to be in retirement. That upfront deduction saves you more money now when your tax rate is high. You're betting that paying tax on withdrawals later at a potentially lower retirement tax rate will be the better deal overall. Also, as we discussed, if your income is simply too high to contribute directly to a Roth, the traditional IRA, even if non-deductible, might be your only IRA option or the starting point for a backdoor Roth conversion.
Okay, so traditional leans towards tax rates lower in retirement or income too high for Roth. What about the Roth?
The Roth IRA often looks better if you believe your tax bracket in retirement will likely be the same as, or possibly even higher than, your current tax bracket. If that's the case, paying the tax now at your current rate on the contributions seems smarter than deferring the tax only to pay potentially higher rates later on what could be a much larger sum after decades of growth. Plus, the Roth offers those other compelling features, the ability to withdraw contributions tax-free and penalty-free anytime, which adds flexibility, and the complete absence of required minimum distributions during your lifetime, which gives you more control over retirement income and helps with estate planning. Those are huge non-tax factors for many people.
It really sounds like a big part of this is trying to predict the future, especially future tax rates relative to current ones. And that's hard.
It is. It's forecasting. And nobody has a perfect crystal ball. Tax laws change, your income might change in unexpected ways, but you have to make the best decision you can based on your current situation and reasonable expectations. You layer that tax rate prediction with your current income level. Does it allow a Roth contribution? Does it allow a traditional deduction? How much you value withdrawal flexibility, and how you feel about being forced to take RMDs later on. Putting all those pieces together helps guide the choice.
And clearly, navigating all the specific MAGI limits, the phase-outs, the employer plan coverage rules, the withdrawal nuances we dove into, it requires paying attention to the details, maybe even checking those IRS publications like 590A and 590B directly.
Absolutely. And keeping good records, especially using forms like 8606 for non-deductible contributions or conversions, and being aware of forms like 5498, which reports your contributions, and 5329 for penalties, is just part of managing these accounts properly over the long haul.
This deep dive really hammered home that choosing traditional versus Roth isn't just like picking flavors. It's a real financial strategy decision with long-term consequences.
It truly is. You're positioning your savings within the tax code to try and maximize what you end up with after taxes. Done right, the choice can make a difference of potentially hundreds of thousands of dollars over a lifetime of saving and investing.
Okay, so let's recap the absolute core trade-offs one last time. Traditional, potential tax deduction now. Taxes deferred on growth. Withdrawals are generally taxable in retirement, unless you have basis. RMDs start at age 73 or 75. Income limits affect deductibility if covered by a work plan. Roth. No tax deduction now. Contributions are after tax. Growth is tax-free. Qualified withdrawals in retirement are tax-free. Contributions can be withdrawn tax penalty-free anytime. No RMDs for the original owner. Income limits affect eligibility to contribute directly.
That's a perfect summary of the key differences derived straight from the guidance we've been discussing.
You know, listening to all this, it leaves me thinking about that prediction piece again. We talked about predicting future tax rates. But what about the value of certainty itself? Like, how much is it worth to know for sure that your Roth IRA money is growing tax-free and will be tax-free when you take it out, compared to the uncertainty of what tax rates or even tax rules about retirement accounts might look like 20, 30, 40 years from now when you start pulling from a traditional IRA?
That's a fantastic point. There's definitely a psychological or planning value to tax diversification and tax certainty. For some people, locking in the tax treatment now with a Roth provides significant peace of mind. It simplifies their forecasting for retirement spending because they know that bucket of money won't be subject to future unknown tax rates. Even if mathematically they might have come out slightly ahead with a traditional IRA if rates dropped, the certainty of the Roth might be worth more to them. For others, maximizing that guaranteed tax deduction today with the traditional is paramount based on their current high income. It really is a balance between today's known benefit and tomorrow's potential certainty or uncertainty.
A really interesting layer to think about, beyond just the numbers, something for everyone listening to mull over as they map out their own retirement journey.
Indeed. It adds another dimension to the decision.
Well, this has been an incredibly detailed look into the rules and realities of traditional versus Roth IRAs, all grounded in the official guidance. Thanks so much for breaking down all that complexity with us.
My pleasure. It's crucial information for anyone serious about saving for retirement.
And a big thanks to you, our listener, for joining us on this deep dive. We genuinely hope this helps bring some clarity to what can feel like a really complicated but very important retirement savings decision.
Until next time, happy saving.